Welcome to CRETN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
All right, welcome to Commercial Real Estate Pro Network. My name's J. Darren Gross. We are building a resource for investors and professionals dealing in commercial real estate. We're doing this by interviewing influential commercial real estate experts across the country. We're asking questions and digging down to get some answers. You can find us by searching Commercial Real Estate Pro Network. You'll find us on Facebook, YouTube, Twitter, LinkedIn. And if you like what we're doing, all we ask is that you let us know. The commerce of social media is to like, share, comment, and please share in your own network. Today, we are going to take a look at a timely topic, given that we're in the tax season. And if you haven't begun, you're probably starting to gather those documents if you're going to try and file on time. And the topic we're going to dive into today is the 1031 exchange. And what I believe and what I find is that, like a lot of terms get thrown about rather loosely, I believe the 1031 exchange is not understood by most who need to understand how it can benefit them. And if you are a real estate investor and you're looking to sell a property, you definitely need to understand how and why a 1031 exchange works. And again, it's a vehicle available to real estate investors looking to sell or upgrade their property. So to help us understand the what and whys about 1031 exchanges, we are fortunate to have today's guest. Peter Harris is our guest today, and I just want to say be prepared to be enlightened. Peter was trained as an engineer. He's a commercial real estate broker, real estate investor, and author and co-author of a couple of books, including Commercial Real Estate Investing for Dummies and Amazon.com's #1 bestseller, Commercial Real Estate for Beginners. My guest again today is Peter Harris. Peter, welcome to the program.
Thanks, Dan. Thanks for having me. I really appreciate it.
I couldn't be more happy to have you, and I'm so excited to get this conversation going and dive into 1031 exchanges. But before we get started, if you would, for our listeners, give a little bit more of your background and tell us how you got into commercial real estate.
Sure. Yeah, I was. I'm born and raised here in California, Northern California, and after college, I started a career in engineering, and shortly thereafter, my bubble bursted when my mentor at work, my boss, was laid off without him knowing it, and my life kind of flashed before my eyes that if they can do this to this famous person, and he was actually famous, they could do this to me. So they actually wanted me to move into his position after laying him off, and I went home and talked to my dad, and we both concluded that, I'm going to strike out on my own. So I kept the job, and I went ahead and hired a PhD and another salesperson that I can, replace my boss with. And then the company did well, but in the background, I really started investing more and more and more. I started off with single-family homes, and within 2 years, I grew bored of that and slowly started getting into apartments and commercial. And 7-unit, and then 20 and 44, and then, all the way up to almost 300 units, one purchase. So a couple of self-storage facilities along the way. And in the meantime, I really took a passion to sharing with others what I did, and really enjoyed that. And so I started educating people on what I did, and that has worked out well, too. So that actually has become a little more fulfilling than owning all of these properties. So it's kind of my story in a nutshell.
I love it. I love the whole to start out and kind of recognize an opportunity and to grab hold of it and grow it. And it's a story I love. I can't hear enough of when I talk to people, and especially if they've accumulated any volume of units. It's a story I love to hear. And thanks for sharing that. And
you're welcome.
Thank you. And before we get started, too, I want to point out to our listeners that, as I mentioned in the introduction here, Peter is an author. He's authored. How many books have you authored now?
I authored 3 books so far.
Okay.
Yes, I have Commercial Real Estate Investing for Dummies, Commercial Real Estate for Beginners, and I also did a product back in the day with Donald Trump. Wow,
you've been circulating in some circles with some big names there. That's a lot of credentials there. But anyway, what I wanted to point out to our listeners here is that Peter has graciously offered to the first 25 listeners who submit the special offer form, and if you go to the Blog Talk Radio below the play button, you'll see in the description there's a special offer link, and if you click that, Peter is going to offer up a copy of his ebook. Multifamily investing. What do we call it? It's Creating a Financial Fortress Investing in Apartments. Is that right?
That's right. Yep.
And I've got down here, it's 200 pages, and sells retail for $19.99. So a terrific value there, and we thank you very much for that. And again, look on the below the play button on the Blog Talk, and you'll see the special offer, and you can get to it through that. So before we get, now we've dispensed with all of the preliminary introduction stuff here. Let's get into the conversation here. And again, setting the stage here a little bit, most of our listeners are either real estate investors, or in some cases they work, not in some cases, either they work in, they are investors, or they want to become real estate investors. And myself included, a real estate investor, and one of the things that I've always loved about real estate is the appreciation factor over time, how you can start with a property and over time, just based on inflation, even if the balance remains the same, the value increases. And a couple of things, especially this time of year, that I'm aware of is the depreciation built-in feature on your taxes with real estate. But what I'm shocked and I'm just dumbfounded sometimes when I am talking with people that have significant assets in real estate, and it's time for them to sell a property, that how many of them don't know of or don't understand or have not even considered doing a 1031 exchange. And so, Peter, maybe you can take it from there. We'll start with, that's kind of the landscape I'm seeing. And
sure.
Go from there.
Okay, yeah, great. Yeah, you're right, Darren. And just a lot of people that I know as well, they will, either have inherited a home from their parents or bought it 15 years ago, 20 years ago, even 5 years ago, and are sitting on a bunch of equity and not sure what to do with it. And so here's a scenario. Let's say that this home that is now an investment property, and you rent it out. Let's say it has over $200,000 in equity, and as we know, equity sitting it doesn't put any money in your pocket. And but let's say also the property is bringing in a little bit of cash flow, but not a whole lot. the property's getting older, needs some repairs. The question is, what do you do with it? You can refi it, you can put cash out, you can fix up the property, but will that increase the property value in its cash flow? Probably not, right? And then also, let's say you're getting older in the years and you're thinking about retirement and you have all this equity in this rental property. What do you do? And for most folks, my experience, Darren, is most people have always been curious about commercial real estate and how it works, but they always thought it was complicated and perhaps out of their reach. So what are your options with this scenario? Number one, you could keep the property and do nothing, just hold on to it, and just keep it out of fear. And number two, you can sell the property and then use the proceeds to buy another property, a fresher property, right? And with this. And let's say you have a $200,000 capital gain. What's going to happen is you're going to incur a tax liability and of about maybe $70,000 in combined taxes. And we're talking depreciation, recapture, federal and federal and state capital gain taxes. So when all is said and done, $200,000 minus $70, you're going to have about $130,000 remaining to put into the other property. All right. So, however, before I even go on, let's say you have $130,000. What can you buy with that $130,000? Well, if you put down 25% on the new property, you can buy a property worth about $520,000. Right. So that's an option. Mm-hmm. All right. The other option you and I are referring to is called a 1031 exchange. So basically, you can sell the property and enter into a 1031 exchange. And if the same investor chose to do that, the entire $200,000 of capital gain will be able to be put into the purchase of an $800,000 piece of property, with the entire $200,000 down as a down payment. So, and you won't have to pay the capital gains and also recapture the depreciation. So the entire gain moves forward, all right? So the tax hit, the 35% tax hit is actually deferred until you actually sell the property. Some people call it tax-free, but it's actually tax-deferred. So that's the beauty of doing a 1031 exchange.
So, in that, when you do that, you take that depreciation and the equity, and you roll that into the new, or I guess the gain and the depreciation into the new property. Does the new property then retain the old property basis, or do you? Does that? You mentioned it's deferred, right? So it's still there. It's just you don't have to pay it when you sell out of the one property and go into the next property, correct?
That's right. The gains are deferred. The capital gains taxes are deferred. Depreciation, this is a tax question. I'll defer that to tax person, but the depreciation gets to be refreshened on the new property. So if you go from a single-family home, let's say you wore out all of the depreciation, you owned it for a while, you can buy a brand new property and start writing off depreciation again on a much larger asset.
Huh.
That's the beauty
like
of it's a beautiful thing.
Yeah, no, when you talk about going from a $520,000 property to an $800,000 property, that's a big. That's a whole nother level of property, and I had a customer years ago. He's still a good friend and customer, but he had purchased a property that was for his business, and the little did he know or fully understand, he had purchased something that was right in the way of progress. And before he could get his business moved into the property, the phone started ringing off the hook by all these brokers trying to buy his property. And finally, he just threw out a number. He took the price he paid for it and doubled and said, okay. And they said, fine. And then he called me and he goes, well, I guess we're going to pay taxes. And I was like, wait a minute, you need to talk to somebody. You need to get some advice, because and this was, north of $1 million kind of a gain kind of thing. And it's just, just to either just make the decision and pay the taxes or actually be able to do something with it. And that's a game changer for your family and your estate and the security that you're able to provide by doing that, as opposed to just paying the taxes on that. So.
Oh, without a doubt, Darren. Myself personally, I sold a single-family home in the 2000s. 2000, I believe it was 2001, I believe, and I sold it into a 11 units. All right. And then I went from there, and then about 3 years later, I went from the 11 unit into an 87 unit. So it just grows from there. It just grows from there. Yep. So you want to talk about boosting up your wealth and having something for your kids and your kids' kids. You really need to understand how the 1031 exchange works.
Right. No, and I think just that understanding, like you said, if somebody's been in a single family investment mode, and I think most people, unless you've understood and had the ability to leverage into something bigger, that's probably where a lot of people start. And the numbers are so dramatically different, as I've come to understand, as opposed to when you get into the multiples, and how you can actually, the appreciation and also the cash flow on those things, and to really take advantage of that you've accumulated and put that back to use, and really create a much more positive income stream, set yourself up for additional appreciation. And let's face it, if your appreciation rate's the same, and you're comparing a $200,000 property to an $800,000 property, at the end of whatever that time frame is, that number is going to be a whole lot bigger on the $800,000 property than it will be on that $200,000 property.
Oh, without a doubt. And here's the good part. So if you were to go from a single-family home to a commercial property has a unique advantage, right? When you value a single-family home, you want to know what it's worth, you go around the neighborhood and you find out what other property is sold for, and that's your value, right? Mm-hmm. Now, with commercial property, we do two things to value the property. Number one is we also go around the neighborhood to determine what the property is worth, per unit. But we also have a thing called the NOI, the net operating income. And over time, if you can increase the net operating income, the property value goes up as well. And so the net operating income is basically your effective gross income minus your expenses. All right. So as your bottom line goes up in your commercial property, as it should every year, so does the property value. All right. So you get kind of a turbo boost in your wealth by shifting from residential to commercial. Commercial is a single family, duplex, triplex, fourplex. No matter what you do to those rents, it's not going to increase your property value. If you were to increase those rents to commercial property, you can increase your property value 10, 20, 30, 40% higher in gains just because you raise the rents. So that's the big difference between residential and commercial.
Well, and let me just give you some kudos here. I did read your book, the Commercial Real Estate Investing for Beginners. I can't remember what the name of that one was, but you did an excellent job of explaining just what you did there, and it gave several examples, and it was so enlightening. I was showing it to my wife, who she's always happy that we have renters and that, but has not really chose to really get in and understand all that, and that really the light goes on when you understand just what you explained. and how that net operating income and how the cap rates and how that really you increase the rents, you lower your expenses, your operating is that much better, and how much more profitable the whole or how much more valuable the whole property is. It's truly two different worlds compared to the single family or the residential single family, and duplex properties.
It sure is. You think about maybe a 20-unit apartment building. If you raise the rents, maybe $50 over 2 years, you could very well increase your property value by $300,000 or $400,000.
Yeah.
Try doing that in a single family home. You can't. So that's the power of the NOI. Mm-hmm.
Yeah, you'd have to have the lottery winner renting from you there. Probably not going to happen. Hey, let's talk a little bit more about the 1031 exchange. So the basics are you're able to take the gain, depreciation, or at least let's just leave it at the gain from property A and roll it into property B.
Mm-hmm.
Give me some mechanics on that. Do I just go to closing with the buyer, collect the check, put it in my bank account, and then wait for another property to reveal itself, or how does this all go about? What are the mechanics behind all this?
Sure. Well, the mechanics are determined by the IRS. And so when we say 1031 exchange, so the 1031 is an actual tax code from the IRS. So we call it a 1031 exchange, and it's also known as a tax deferred exchange. And basically, it's just a simple strategy and method for selling a property that's qualified, and then acquiring another property within a specific time frame, all the while deferring your capital gains taxes. All right. So there are specific rules because it's the IRS, and so here are some of the rules. Number one is it must be for investments only, not personal property. So it's for investment property, business property, again, not personal. So you can't swap out your primary residence for another. All right. Number two, it must be what they call, what the IRS refers to as like kind. And it doesn't mean what you think. So you can exchange basically your single-family home for an apartment building. You can exchange your apartment building for raw land. You can exchange if you have a ranch that you've been using as a business or investment, you can exchange it into a strip mall or a shopping center. You can exchange your single-family home for oil and gas. Even works of art. So the rules are surprisingly liberal, but it's all spelled out in the 1031 exchange tax code. Here's interesting thing. Here's what's not eligible for that. Again, your primary residence. You can't involve any type of stocks or bonds or notes. You can't exchange out partnership interests and inventory. All right. So it must be a like kind. All right. The next rule is in designating your replacement property. So for a 1031 exchange to be valid, there are two timing rules you must observe. So once the sale of your property closes, the 1031 exchange company, we call that your intermediary, they receive the cash, right? And within 45 days, you must identify the replacement property in writing. All right, that's rule number one. All right, and so rule number two is you must close on the new property within 6 months. All right, 180 days. All right, so the 45 days and the 180 days they run concurrently, meaning you have 45 days to identify your property, then you have 135 days to do the actual closing. All right. And if you go 181 days, you no longer fall under the tax code 1031, and you have to pay the taxes, the capital gains, right? Other rules are any cash is taxed. So if you have any cash left over at the end of the 180 days, that cash, we call it boot, and is taxed as a capital gain. All right? Another thing to be aware of is mortgages. So you actually must consider any mortgage loans or debt on the property that you sold, and any debt on the replacement property you're going to acquire. So if you don't receive any cash back, but your liability goes down, that too will be treated as income, just like cash. So in other words, debt and equity in replacement property must be equal to or greater than debt and equity in the relinquished property. All right. So in a nutshell, if you buy a property, if you sold your property and you sold it for $300,000, right? And so the property you exchanged into, the sales price must be equal to $300,000 or greater. And if that first sale, your loan is $100,000, your new loan and new property must be equal or greater than $100,000. Okay.
Right. So the bottom line is it's got to be it's got to be more. Is there any percentage or amount more of, or just more than?
No, it is be equal to or greater. Equal to or greater. And the last rule is there are companies out there that specialize in holding your money and helping you qualify throughout the process. So you must use a qualified 1031 exchange company. Again, we call them the intermediary. So you can't go to your accountant, you can't go to your attorney and say, hey, can you do this for me? So they have to be specifically set up and qualify under the IRS rules as a qualified 1031 exchange company. So, and there are a ton out there. So there's tons of them out there. And everything I just said, all of this stuff is on the web. So this is not a secret. So it's a very popular thing to do, just so that the rules are very specific and very strict and the timelines are.
Got it. Let me ask you a question here, because I think I ran into this here a little while ago. So the primary way this is set up is that I have a property. It's got a gain. I want to move the gain into another property. I sell the one property, and then I've got 45 days to identify my next property. The money has to go from the sale into this intermediary, and then I've got, like I said, the 45 days to identify the property, and up to the 6 months to close that purchase. Otherwise, I have to pay tax on what was acquired. What is there a way that, because I mean, this has never happened, and I'm sure it would never happen, but let's just say that the buyer couldn't act before, the property I wanted to purchase to replace, the buyer couldn't act before I needed to acquire the next property that I was moving to. Is there any way to do that, or is it just you gotta wait?
Sure. Well, when you are designating your replacement property, there are about 3 rules you can use to identify your next property. So in your case, you would fall under the 3 property rule. Basically, you can identify any 3 properties regardless of the value. So if your first property couldn't close, you can go to your second one. All right, and if your second property can't close, you can go to your third one. It's just that any property that you choose under the 3 property rule must be greater than or equal to the property you just sold.
Got it. So you can identify more than just the one, just as and identifying it. Do I have to do a formal offer and have it accepted, or is it more a matter of let my party or the intermediary know that, hey, this is the property I'm looking to purchase?
Yep. Within 45 days, you have to send your intermediary a 3-line item sheet of paper identifying the 3 properties within 45 days. And then after the 45 days, you have 135 days to buy one of the 3.
Okay. All All right. Well, that seems, fairly cut and dry there. I mean, it's rather simple, and the benefit seems to be significant. What have you had? Have you worked with anybody? Have you got any horror stories where somebody kicked themselves because they didn't know about this thing, or?
Oh yeah, all the above, Darren. All the above. I've done a ton myself. I've helped others do the same. Some have come to me too late. Some have come to me and they just didn't do the research and have had to pay the taxes. So all the above. So I have this. Whenever I work with someone who's contemplating doing a 1031 exchange, I'll have them go through. I'll set them up with 3 different scenarios, right? And I'll call this, the pre-exchange duties. I'll give them that, and then I'll discuss with them duties during the exchange period, and then lastly, what I call the post-exchange duties, right? And all 3 you have to really consider up front, and at the same time. So basically, before you even consider selling your property and going into a 1031 exchange, first of all, you have to have a plan on what you plan on exchanging into. Is it going to be an apartment, self-storage, retail? What is it going to be? So the number one reason most exchanges fail is because of that, lack of planning. You just can't take a 1031 exchange lightly. It's a hard thing to do. It's a hard thing to do to find a replacement property. So what you have to do is you have to get educated a whole lot. You can read my Dummies book for commercial. You can read my apartment book. You can do all the above. But number one is before you even think about doing an exchange, consider what you're planning on exchanging into. All right. The second thing is that, and the reason why I'm sharing this with you is that a lot of people blow exchanges, and then they also blow the reason why they're exchanging. I mean, the reason why they're exchanging is they want to take their income to the next level. They want to expand their net worth, and then these things can be totally ruined if you don't follow these rules, right? And these are pretty much, I think, practical, I call life-saving tips. All right. So number one is to plan. Number two is once you decided to do an exchange, I want you to start doing research on the areas that you like to buy into. All right. And for example, have real estate agents look for deals for you. But so far as the areas, people always ask me, Peter, so how do I choose an area? And in commercial real estate, it's pretty easy. Basically, number one is jobs. There has to be jobs in the area. Number two, population. We like for population to be positive, right, in migration. And number three, supply and demand. There must be a certain supply and a certain demand for what you want to invest into. For example, if you want to get into apartments, is there a demand for apartments there? Or self-storage, is there a demand and a supply for self-storage there, right? So not rocket science. Again, jobs, population, supply and demand. After you get through those things, one often overlooked area is lining up your financing for your next deal. Now, commercial financing is a bit different than financing a home, right? So if this is your first time, I suggest you find a commercial lender and get a little educated. And luckily today, commercial financing is looking quite favorable, compared to what it was, 3 or 4 years ago. So that's what I consider pre-exchange duties. So just thinking ahead and going about it in a very smart manner. Did that make sense, Darren?
Oh, absolutely. And I think the first thing is that you understand what it is, but now how do I do it? And like you said, have a plan. If you don't have a plan, how are you going to know if you're going to be successful if you don't have a plan and kind of a direction? You might get lucky, but my guess is that you'd be well served to have a plan and have a sense of what the outcome's going to be and what's needed to be successful. So I totally agree.
Right. Some people do, Darren, is they'll just say, hey, I'll just call a broker, and a broker will help me, a commercial real estate broker. And, they can help you find a property. But, you need more than that. You need more than that. They are the experts in finding a property and the transaction. But are they the experts in making the property cash flow? Are they the experts in, making sure this area is conducive to making an investment? Probably not. Probably not. They're sales experts. They're not operational or demographics experts. So that's where you have to be a little more educated when you jump from residential to commercial.
That's good advice. That's good advice. And on that financing thing too, I just know in my own personal experience, like you said, with a residential loan, I think they can pretty much, with a Social Security number, get you qualified. There's a score, and congratulations, you're the homeowner. But really having your financials put together so that when you show up at the bank or talking with your lender, everything makes sense from left to right, top to bottom, and they don't have to work to understand it. I found that just to be a huge, huge benefit for your ability to get what you want.
Oh yeah, you're right. Residential, basically, you take your credit application, you make sure you have money in the bank, and the home is standing, and then you give you a loan. The commercial, they're going to look at you, of course, and your credit worthiness, but they're also going to look at the property's financials to make sure it can afford to pay for the loan, and they're going to look at the property's condition itself. So there's three things they're going to weigh in making the decision. All right. So again, you just can't say, I'm going to do an exchange, find a broker. No, you need to get a little more educated and, read my book. It'll share with you exactly what you have to do to get educated to make wise decisions.
That's great. So we've talked about every reason I can think of to do a 1031 exchange. Is there any reason why not to do a 1031 exchange?
Yeah, there is. Let me, I can explain this by going into what the duties are, what your duties are during exchange and after the exchange, and you can figure out what the positive and negatives are. So your duties during the exchange period is obviously you want to make sure you meet all of the 1031 exchange timing and replacement requirements, right? Secondly, this is something people don't do. I don't know why. Is you need to, since you're going from a residential to a commercial, I want you to find and interview at least 3 property management companies. See, no one tells you to do that, okay? And so you have to find and interview at least 3 property management companies, right? So you're going to go from a single-family home to a 10-unit, and if you have no 10-unit management experience, do not try managing by yourself. All right. If you do, another investor is going to come along and buy your property very cheaply because you're going to blow it. All right. So have them manage it for you first. Learn the tricks of the trade, and then if later on you want to get in the management yourself, do it. But initially, get a qualified property management company to do that for you. I explain how to do the interview process in my apartment book that I'm giving away today. And but here's probably the most important thing, and this is where most commercial real estate investors blow it, and why their properties don't cash flow or even live up to the expectations. You need to have your property management company and yourself come into agreement as to how much income the property will produce, what the annual expenses are going to be, and finally, what the cash flow of the property is going to produce for you. All right? So do not believe the real estate agent or whatever performance they produce for you. And again, he's the sales expert, and the property management is the operations expert. All right? So most people think that, on paper, this cash flow is $100,000 a year. In actuality, there's no cash flow. All right? Because you underestimated everything. All right? Because you didn't have an expert come in agreement with you that, this is the income, this is the expenses. Just because it's on paper does not mean it's going to be in actuality. So that's the most important thing that people miss out on. maybe because they're smart or smarter than me or smarter than property managers, but you really have to come in agreement with someone who's smarter than you that this is how the property is going to perform and this is what I can pull out of it. All right? Does that make sense, Darren?
Oh, absolutely, absolutely. And I'm just, my brain's kind of, there's two things going on. One is I'm nodding my head based on experience and memories of just, like you said, the numbers don't work like the numbers said they were going to work. And then the property manager, that's great advice. I have had numerous clients suffer the woes of what they thought was a good property manager, and only to find out that the only guy in the deal getting paid was a property manager. And you know, it's just critically important. And like you said, I mean, I love the fact you say, you know, interview 3, and that's kind of the homework you have to do during the process. That's great.
You do. And I'll tell you, you know, people always ask me, Peter, what's the most important thing when interviewing a property manager? It's easy. You know, they all have the same education. They have the designations after name. But what sets them apart is, guess what? Integrity, right? So if you look the guy or the gal in the eye and you get a gut feeling that there's something wrong there with that person, honor your perception. There probably is. They're probably not honest, right? Move on. Mm-hmm. But if you can look him in the eye and say, okay, I'm going to give this guy a shot. I have a good feeling about him. Yeah, and then if it turns out being a really good property manager, go ahead and build your portfolio around that person, because a good property manager is gold. It's gold, right? But again, you know, in my book, I put down that 9 out of 10 property managers are not good. No one will argue with that statistic. But if you find that one good one, you can build a nice portfolio around that one good person.
Wow, I didn't realize they were that high, but that's, you know, I suppose if you do the math and go out and find, you probably would concur. But that's just a great pearl of wisdom there for somebody looking to, like you said, you're moving from something that's a single family, looks like the house you live in, you understand, you know, what's supposed to happen, the rent on the first, the roof, you know, water heater, whatever maintenance, or it's pretty manageable, as opposed to, like you said, getting into a multiple thing where you don't understand and God forbid you get in over your head and you have a horrible experience, and like you said, the next guy comes along and buys it for a song because you didn't do what you could have to maximize the property.
Yeah, exactly. And you know, a lot of this information that I'm sharing is in my books. It's out there to be learned, and that's my desire for your audience to get today is, don't just enter into a 1031 exchange thinking you're going to go from a single-family home straight into commercial. Get some education first.
Well, that's well said. And I think with that, I think a great summary there is get some help, get educated. If somebody wanted to reach out to you, what's the best way for somebody to get in touch with you, Peter?
Yeah, probably the best way is on my website. I have a couple of websites. If someone needs help on an exchange or just wants to, get some advice or maybe some consultation, I have a consulting company that I'm running for over a decade. It's called theapartmentconsultant.com. You can reach me there, and basically at peter@theapartmentconsultant.com. You can reach me there. And if a person was just want to get more education, I have an educational company as well. It's called commercialpropertyadvisors.com, where I post a bunch of YouTube videos, podcasts, and trainings of that sort, and all different types of commercial. So you can go there as well. So there's a couple ways to reach out to me.
Great. Well, Peter, I've really enjoyed it, and I'm certain our audience is going to be well enlightened on the importance of and the hows and whys of a 1031 exchange. And I hope we can do this again in the future. There's plenty of other topics we could tackle, and I'd really like to do that if you'd be game.
Sure, yeah, and be happy to do that, and don't forget those that are listening out there, you're eligible to receive a free ebook that's on my website. Retails for $20, and for Darren's listeners, I'm going to be giving it away for free today. So all we ask is you just click on the link that he mentioned before, fill in your name, it'll come to me, and then someone here will send you the book at no charge.
Great. Hey, Peter, I thank you again so much for that, and again, thank you for spending some time with us. I look forward to our next opportunity to talk. For our listeners, that wraps up a show, again, here on Commercial Real Estate Pro Network. If you like what we're doing, again, I can't emphasize this enough. This is the currency of social media, is tell your friends, like, share, comment on what we're doing, share our links in your networks. And remember, you can find us by searching Commercial Real Estate Pro Network. You can find us on Facebook, YouTube, LinkedIn, and Twitter. Our Twitter handle is at CRE Pro Network. Until next time, thanks for listening to Commercial Real Estate Pro Network Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.